As a whole, the S&P 500 offers a measly dividend yield of just about 1.5%, and in an era of rising interest rates and crazy inflation, you may want to consider investing in stocks that offer a better bang for your buck. Having said that, in this video we'll be covering the top 5 highest paying dividend stocks in the S&P 500, all of which have cash flow returns much higher than the index average, and we'll see how they stack up when you compare them to just simply investing in the index. And also, I want to give a quick shout out to today's video sponsor, Southern New Hampshire University, but we'll talk more about that later. Now, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to keep in touch as we both continue to grow our portfolios and collect that cash flow. All right, now the 5th highest yielding stock in the S&P 500 is VF Corporation, ticker symbol VFC, which is a retailing company that owns popular apparel brands like Vans, The North Face, Dickies, and Supreme. And interestingly enough, their CEO actually resigned earlier this week as the company is currently seeing weaker than anticipated consumer demand that is causing them to cut prices just to offload some of their excess inventory. And this not so great news surrounding the company caused their share price to drop over 10% just in one day earlier this week, and year to date they're not doing too hot either. They're down over 61%. Now, if there is a silver lining here, it'd be that this negative share price performance is pushing this stock's dividend yield way up, and as I'm sure you can imagine, it's gone up an unbelievable amount. Their forward dividend yield is sitting way high right now, just under 7%, which is almost 200% higher than the sector median dividend yield, and this is also about 150% higher than the company's 5-year average yield of just under 3%. And taking a look at the rest of the dividend stats, we can see that their payout ratio is a bit on the high side, about 76%. Their 5-year growth rate's nothing too crazy, 4.8%, but they do have a really nice dividend growth history of 48 consecutive years. Now, while overall the dividend stats are looking pretty decent, and while I am a fan of the brands that this company owns, I'm a big Vans guy, as an investor, I'm having trouble getting on board because I don't think the financials look too great, and we don't have to look too hard to see this. Here on the income statement, we see their revenue growth has been pretty non-existent over the last 10 years, which is not great, and the same is true when we look at the earnings per share. Plus, to add insult to injury, their debt seems to be doing nothing but going up, which could forecast trouble for the dividend. Overall, I think there are better options out there, and as much as I want to like this stock, which is one of the highest yielders in the S&P 500, I just can't do it. Now, with that, guys, we still have 4 more stocks to cover today, but first, I want to tell you about today's sponsor, Southern New Hampshire University. Now, as someone who actually didn't finish college and most certainly wasn't after a degree in finance when I was going, there are times where I don't feel the most qualified to talk about some of the topics we cover here on this channel. Because of that, I'd be lying if I said I'd never thought about going back and finishing my degree, and if you feel the same, if you feel like your experience is holding you back from pursuing the career that you really want, then I am so excited to tell you about today's sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online degree offerings in the country, and I want to talk to you specifically about their finance program. In this program, you'll learn to identify long-term corporate investment opportunities to increase shareholder value. You'll learn to apply theories of asset allocation, security analysis, and portfolio diversification to efficiently manage an investment portfolio. You'll learn to utilize the rules and regulations for financial accounting and reporting in a global economy. You'll learn to generate financial records and financial statements for users in accordance with governing rules and regulations. And you'll learn how to analyze, interpret, and communicate financial and accounting information to internal and external stakeholders. SNHU is radically affordable, with their tuition rates being some of the lowest in the nation. Also, when you go to request information about one of their 200 plus different programs, a real person will hop on a call and discuss how the program can benefit you personally. To learn more, go to snhu.edu/Ryan or find the link in the description to see what the current average annual salary is for someone with a finance degree and to request more free information about the program. It only takes one click to find your calling, so once again, go to snhu.edu/Ryan. All right, guys, now moving on to the 4th highest yielding stock in the S&P 500. This is Verizon, ticker symbol VZ, which is obviously one of the big telecom companies here in the United States, and as of late, it seems to have fallen out of favor compared to AT&T, who is just dominating this year. As far as share price performance, we can see that Verizon is down about 29.5% for the year, compared to AT&T, which is doing the exact opposite. It's actually up 33.7%, which is unbelievable. However, Verizon does seem to have a lot more to offer in the dividend department, both in terms of its dividend yield and its growth history. Verizon's dividend yield is 7.08%, which is about 1 percentage point higher than what we'd find with AT&T, and this is high in its own right, but it's nearly 130% higher than the sector median dividend yield, and it's also about 50% higher than the company's 5-year average yield. And taking a look at the rest of the dividend stats, the payout ratio is looking pretty great, just under 50%, but Verizon is not growing their dividend too aggressively. They have a 5-year growth rate of just about 2%, which I guess is a trade-off with the already high dividend yield, but along with that, they do have a nice dividend growth history, so they've been growing it for 18 straight years. I do like to see that. And in terms of valuation, things are looking pretty good. Their overall grade is an A-, and the PE ratio is sitting nice and low in the single digits, 7.1, which is about 51.5% lower than the sector median and nearly 36% lower than the 5-year average. And then scrolling down, taking a look at the forward price to book, this is sitting at 1.71, which is also pretty low, 10.3% lower than the sector median and nearly 50% lower than the 5-year average. And the price to cash flow is looking great too, 4.08, which is about 54.5% lower than the sector median and 33% lower than the 5-year average. Now, I actually have the stock in my own portfolio, and right now it is one of my worst performers, guys. As you can see, I have just under 44 shares of Verizon, and right now my position is down about 28%, which is no surprise seeing what the share price performance of the stock has been in 2022, which is pretty much where all of my losses with this position have come from. Now, moving on to the third highest yielding stock in the S&P 500, we're talking about Altria Group, ticker symbol MO, which is a company that manufactures tobacco products and owns iconic brands like Marlboro, Copenhagen, and Black & Mild. And out of the few stocks we've talked about so far today, Altria has seen the least drawdown this year, and the valuation's actually not looking too bad. Year to date, they're only down about 3.3%, and if we take a look at the right-hand side of the screen at the PE ratio, that's sitting nice and low at 9.6. Now, if you're familiar with my videos, you'll have heard me refer to Altria Group as like a triple threat dividend stock. They've got a high yield, which we can see right there, sitting at 8.14%. They have a pretty high 5-year growth rate, I'd say, especially for high-yielding stocks, sitting at also right around 8%. And they have an awesome dividend growth history of 52 years, making them a dividend king. Now, this is another stock that I have in my portfolio, and as you guys can see, I have about 51 shares of Altria Group, and my position is faring a bit better than Verizon is for me. I'm up about 8% with Altria Group right now. All right, now skipping over to the second highest yielding stock in the S&P 500, this is Devon Energy, ticker symbol DVN, which is an oil and gas producer based in Oklahoma City who has seen a crazy return this year. Now, in the last 30 days, their performance hasn't been too great. They're down nearly 10%, but year to date, guys, they are still just crushing it. They're up over 43%. Now, normally such a drastic rise in share price would cause a stock's dividend yield to go down, but Devon has what's called a fixed plus variable dividend, which essentially means that when business is booming, the dividend is too. Taking a look at the dividend history, we can see this variable dividend in effect, where they've pretty much raised it every quarter since 2021. And this huge jump in the variable dividend has left them with a pretty high forward dividend yield, about 8.5%. And the dividend history we just saw also explains the 5-year growth rate of 60.5%, which is crazy, guys. And the dividend growth history is nothing crazy, 4 years, but they have been making consistent dividend payments for 16 straight years. So there is some consistency there. Now, because the dividend is in part a variable dividend, I wouldn't expect it to stay this high forever. Devon has been benefiting from higher energy prices, which is resulting in more free cash flow, which is why the dividend is currently cycling higher. But at some point, I'd imagine things will return to homeostasis and the dividend payments will follow suit. Just something to keep in mind if you're considering investing in this stock. All right, my friends, now moving on to the big one, the highest yielding dividend stock in the S&P 500 is Vornado Realty Trust, ticker symbol VNO, which is a real estate investment trust with a portfolio of office and retail properties located in New York City, Chicago, and San Francisco. And I've got to say, guys, the yield on this stock may be high, which we'll take a look at in just a moment, but that seems to be the only thing that the stock has going for it. Just in terms of share price, there's nothing good coming out of VNO. Year to date, they're down about 51%, and if we zoom out over a longer period of time in the last 5 years, they're down 71.3%. Furthermore, if we take a look at the financials, we can see that their rental revenue is decreasing over time, which is not a great sign, and this is trickling down to the bottom line, to the adjusted funds from operation, which is what they use to pay the dividend, and this is decreasing as well, which, as I'm sure you can imagine, does not bode well for the dividend. Which, on that note, guys, now taking a look at the dividend stats, like I said, the yield is very high, 9.63%, so that's looking pretty attractive, but the 5-year growth rate's negative 2%, so it's going down over time, and they have 0 years of growth history. I mean, they are paying less of a dividend today, 53 cents per share, than they were back in 2008, where they were paying 70 cents per share, so I don't like to see this. And so yeah, like I said earlier, the only redeeming quality about VNO is the high dividend yield, which we have a word for stocks like this, guys, and I'll let you guess what that is in the comments below. All right, so now that we've made our way through those 5 high-yielding stocks, what we're going to do next is see how these 5 investments, if you put them into a portfolio, would stack up against just investing in the S&P 500. And to do this, guys, we are going to be using what's called the portfolio visualizer, and in here we have 2 different portfolios. Like I said, one with these 5 stocks we talked about, and another that's just the S&P 500 investing in SPY. And in this example, we've accounted for an initial $10,000 investment with monthly contributions of $100 across the last 10 years. So basically 2012 until 2022 year to date. And the verdict is in, guys. Although the portfolio with the high yielding stocks will do much more in cash flow, which we'll see in just a moment, overall your final balance will be much higher if you would have just invested in the S&P 500. In fact, across the last 10 years, you would have made more than twice as much money just investing in SPY. And furthermore, with SPY, you would have seen higher highs in your best years here, and you would have seen less of a drawdown in your worst year by about 5%. 5%. But to be fair, guys, let's scroll down and take a look at the dividend income and see what that looks like across the last 10 years. And the portfolio with the high yielding stocks is here in the blue, and we can see that this does pretty much blow SPY out of the water. In fact, from a cash flow perspective, you'd be generating over twice as much income investing in these 5 stocks than you would the S&P 500, which I guess makes sense, guys, because like we said at the beginning of the video, the S&P 500 has an average yield of about 1.5% compared to this portfolio here where the lowest yielding stock was like just below 7%, so it's a big difference. Now, whenever I do videos like this and make these comparisons, I like to try and show you guys stocks or groups of stocks that would beat the S&P 500, but unfortunately this is not one of those. But if your goal is to actually beat the S&P 500 and still generate some decent cash flow in the process, then what you need to invest in is this right over here. In this next video, I'm telling you all about SCHD, which I think is the holy grail of dividend ETFs. And here I'll show you how you'd actually be beating the S&P by over 20% if you just invest in this one ETF. So click right over here and I'll see you in the next one.